What is up, you guys? Pete DiCarlo here, and today we're going to be talking about when to sell, and more specifically, how to actually scale out of your positions. We're going to be talking about scaling out of options, scaling out of shares, and even scaling out of long-term investments. I'm going to kind of go over the criteria that I use and a lot of the steps that I have learned and that I have actually implemented into my trading style to make the most amount of money possible with limiting the most amount of risk, because we all know that is the most important thing. You're going to have risk when it comes to trading and when it comes to investing, and you're never going to really sell at the perfect time. But with these steps that I'm going to teach you in this video, you can definitely make more money. And that's the point, guys. So if you haven't been here before, my name is Pete DiCarlo, where I help you guys grow your portfolio one trade or one investment at a time. Make sure you hit the like button, make sure you comment down below, and make sure you hit the subscribe button because it helps this channel grow. Now, the first thing I'm going to do is put this little kind of crappy thing I made on Photoshop up here, but I want to explain to you guys the process of doing this before I actually show you real world examples. So in this example, we're going to actually use options. This works best with options, but it can also work with shares. The reason it works so well with options is because the percentages are much higher. So you can see here, this is just a fake stock that I created. You can see that these are the price levels: $10, $20, $30, $40. And let's pretend that we bought 4 contracts, 4 calls on this stock at $10. You're going to see here that this blue line is going to be our projected price targets. And you're going to see here these red lines are going to actually be your resistances. So before taking the position, obviously we first find our risk versus reward, and obviously it's worth it in this point. That's why we took it. But for instance, we see that there's a resistance at $20. There's also a resistance at $30. There's a resistance at $40. So say we do purchase 4 contracts at $10 and the stock goes up to $20. Now, at the time of this stock hitting $20, our options are up 100%. We have 4 contracts that are up 100%. Now, what you could do here is just hold it, which in my opinion is not smart because you're up 100%. You want to take some of that off the table. You don't want to just have the stock, fall for some stupid reason, or the market takes a fade and you lose those profits. Because remember, when you're trading with options specifically, you're going to deal with decay. So in my opinion, I try to take some profits off the table as fast as I possibly can. So in this example, what I would do is when we hit that resistance point of $20, I would take 2 contracts off the table. So I would take 2 of those and I would sell them. The reason for this is, number 1, to take, some profits off the table and limit the risk. But number 2, since we've doubled our money, anything in the future is free. If for some reason the stock goes from 20 down to 0 somehow, it's a free trade, because the money that we made and the money we took off the table was the principal that we originally put up. So in this example, the trade automatically is free. And in my opinion, playing with house money is the best type of money to play with. So we sell 2. Now it continues to push up, continues to push up, continues to push up, and it's starting to really get overextended. And we're all the way up at $30, which is a resistance. Once again, this is free money, so you could just let it ride. But what I would do here, we still have 2 contracts left. I would actually sell 1 of the contracts. So now we went from 4, we sold 2 at 20. Now it's a free play. They double again. I'm going to take 1 more off the table. Then we take a fade back. We push all the way up to 40. And what I would do at that point is just sell. And of course, the stock could continue to go up, but I would just end up selling there. Now, the reason for this is because as the stock, especially with a trade, as it goes higher and higher, the risk versus reward becomes worse and worse, because now we're risking a lot more of our profits and the overall position than the actual reward that we could potentially make. And I want to show you this in an actual specific example where I did this with Take-Two Interactive. And I want to show you how this actually worked in my favor, and then I want to show you ANGI, which is going to be another good example. So Take-Two Interactive, this is a daily chart. You can see here that we have a really good bullish flag. So a bull flag, you can essentially see here that this is your flag pull. This is a really strong bull flag. And the spot in which you would want to purchase this would be right around confirmation of a breakout. So I purchased this, let's see, my first couple shares right around this price range right here. So $159, we had a push up, we had a pullback, we bounced at support. And what I did was I went in with 4 contracts specifically. We bounced perfectly. We pushed all the way up 2 days later, 5%. I was up $400 on this play. And what I did was I actually sold 2 of the contracts because, and if you guys don't understand how to draw support and resistance lines, make sure you hit the subscribe button because I have tons of different videos on that and a lot of other technical analysis videos coming out in the future. But if we just start dropping some price lines here, we can see that we have a big resistance around $168. We rejected here once. This was a support. Then we broke it. We rejected here twice and then the third time. So we have a resistance point right here at 170. That's why I decided to sell 2 of them. I was up $400 and I said, hey, I'm going to lock in some sort of profit. So I sold 2 of them right around here at like 167. Now, actually what happened was the stock took a big fall all the way down 5% to where I originally bought in at. So at this point, instead of actually being down, I'm still even on the play. Now, in this case, if the stock continues to fall, it breaks support where I entered and it goes all the way down to $154, I will end up losing money, but I will not end up losing as much money as if I held the original amount. This is why we scale out. This is why we don't just hold the actual position, because if I held the whole position, I'd actually be down where I bought it, but I'd overall be down because decay is working against me this entire time. Now, we can also draw another price line all the way up here at $178. These are the 2 levels where I would be looking to get out at. So, I purchased down here at 159. Let's say that when I sold the other 2 at 167, instead of it pulling back, it just pushed all the way up to $180. Well, if it pushed all the way up to $180, what would I do? I had 2 contracts left. I would probably sell all of them because we're at major resistance. But if I wanted to still continue to be in the play but not have as much risk on the table, what I would end up doing is actually selling 1 of my contracts and letting the rest ride all the way up to like $190, potentially $200 if we had, a massive breakout, especially with earnings coming up pretty soon. So the reason of this is so that, number one, we can continue to stay in the play, but we don't keep, all of our risk on the table. Now, something cool that's happening right now is, I went in with 4, I sold 2 for a small profit at 167. Now we're all the way back at 159. I could actually re-enter with those other 2 shares and average down on the position I'm at, and that quick money that I made originally is already in my P&L, and I'm actually up overall net on the trade. So I could actually just re-enter and keep the small profit that I banked on those 2 options. Now, let's take a look at ANGI. The same thing goes for shares. So let's say that you're not going to, go in with options. Let's say that we're going to go in with shares. So same sort of setup, nice bull flag pattern, nice breakout, confirmation of a breakout, pull down to the 1-day EMA. So let's say we wanted to enter this position right here, and let's say we just did it with shares. We went in with $10,000. Well, the next resistance point is going to be right up here around $12.48. We actually see like a little mini cup and handle forming here. The next resistance point is going to be all the way up here at $14.84. So we have a resistance point at $12.84, a resistance point at $14.80, and a resistance point at $16.29. So let's say I entered here with $10,000. I'm sorry, $10 wouldn't really be much, but let's say I entered here with $10,000. Then we get a nice 10% push up to around $13. Well, I could actually go ahead and sell about $2,000-$3,000 worth of my position because the risk versus reward is no longer there. And that's what's most important, guys. Risk management is the most important thing when it comes to not only trading, but investing. So in this instance, it pushes all the way up to 13. I sell $2,000 or $3,000 or 20 or 30% of my position. It pushes up again to $14.75. I go ahead and sell about this time because the risk is a lot higher than the potential reward now. Because if it goes from 15 all the way back down to where I bought it, that's a 22% loss. It can really only go up another 10% until we hit major resistance. So the risk versus reward ratio isn't really there. So at this point, I would actually go ahead and sell about another 20, 30, maybe 40% of my position. And then if it pushes up to 1646, which is where I originally planned to sell, where I saw the major resistance point at, I would sell the entire thing. And what you want to do essentially is figure out where your major resistances are when you take a trade and then start scaling out at those resistances. Because yeah, you're not going to make as much money as if you just let ANGI go from here all the way up to $17, $10,000. That'd be a 47% return. That's $4,700. I would not make as much as that. I'd probably make about $2,500. But the point is that I'm limiting the potential downside for if something bad does happen. Let's take a look at just a long-term investment. Let's say that you really like Smile Direct Club as a long-term investment and you purchased all the way down here back in March around $3 and we'll say $4. That's a better price, but you ended up getting in here at about $4. That's more realistic. You wouldn't get in at the very bottom. Well, Jim Cramer, he looks ridiculous on CNBC, but what he says a lot is think of it as, buying or just investing in general as like buying clothing, right? If I bought this t-shirt for $4.85 and 3 months later the t-shirt was worth $13, would I buy the t-shirt again? If the answer is yes, which in this case, yeah, I would, then fine, hang on to it. However, if I bought this t-shirt for $4 and it's worth $50, would I buy it again? No. Now, of course, t-shirts and companies are completely different, but it kind of stands the same. If you purchased here at $4.54 and now we're all the way up at $12, you are already up, let's see, you're up 231%, which means if you would have put 10 grand in, you would have made $2,224 in profit, which means you have about $32,000 worth of stock right now in this company. What I would do at that point is say you look at Smile Direct Club and you're like, well, I bought for $4 and it's trading at 13, and I don't think 13 is a good price. I think it's fair. I wouldn't go buying at 13, but I want to hold at 13. But let's say a better opportunity comes your way, or let's say that you just are afraid to have that much money in Smile Direct Club and you want some cash on the side because the election's coming up. The market's starting to get crazy again. What you can do is sell half of your position, sell 25% of your position. But even if you sold half, you still have about $16,000 left. If Smile Direct Club pushes back up to, 15, 16, 17, 18, once again, you could sell half again. That is the point of scaling out, is to remove risk. Now, let's say you did your due diligence, you bought into Smile Direct Club at $4 and you're like, hey, I'm not selling for 10 years. But you don't got to worry about scaling out. But if you're somebody who wants to limit your risk, whether you're trading or investing, scaling out and learning how to scale out is very, very important. In the market and even in real estate, we say you make your money when you buy. It's true, but I know a lot of people who have problems selling, right? I sell too early. This is something that has really helped me because I sell too early. I'm really good at picking stocks, but I'm really bad at selling stocks at the right time. What I normally do is I sell companies and I sell trades way too early. One that I actually just did, and I should have used this exact method, but I didn't because I had too much money in it, and we're going to talk about that later, is SPCE. I had about $15,000 in SPCE. We took a big pump up to $20. I sold all of it. Then we pushed all the way up to 23. What I should have done was sold half at 20 and then let the rest ride. So guys, I hope this video helps. Make sure you hit the like button, comment down below, subscribe to this channel. It really helps us grow. If you want to join our Private Stock Market Academy, we have over 55 hours of courses and lectures. I go live like this every single morning with the team. I go over what I'm trading, why I'm trading it. I go over live exactly, you'll get notifications of what I'm trading, and you get 90% off your first month. So there really is no reason not to sign up. Use the code 90OFF. I'll put the link down below and the code below to start for $10, guys. All right, until next time, thank you so much for watching, guys. Peace.